Today, we're gonna dive into TikTok to see what ETFs they recommend. Will this be an absolute disaster, or will there be a little bit of hope coming from TikTok in which people actually give good ETF recommendations? There's only one way to find out. So into the fray we go.
Here are the 3 best ETFs to hold in the midst of a recession.
I am already a little bit nervous. I'm already a little bit nervous because this sounds like market timing. Market timing is the idea that based on what's going on in the market, you should buy or sell. And people are notoriously bad at this.
The stock market has been in shambles since the beginning of 2022. Inflation is the highest it's been in over 40 years. The Fed is raising rates like it's 1994, and Vladimir Putin is still attempting to launch World War III. But these low-cost ETFs combat recession much better than others.
Everything is bad, so what you need to do now is sell your stock ETFs and buy the conservative stuff. So now that you have low value on your stock, sell low and buy the conservative stuff that people have been running to, which is probably higher. You can see how market timing doesn't work. And this guy has the nice music in the background. He's making you feel good. But this is just sell low, buy high.
Coming in at number 3 is Vanguard's healthcare ETF. The healthcare industry is known for outperforming the S&P 500 in times of recession and or high inflation.
So the healthcare ETF is a 100% stock ETF. The stock market is pretty volatile. Additionally, you're adding on more risk. Investing in a sector means all the legislation that targets that sector now dramatically affects your portfolio. If the United States passes some regulations on the healthcare industry, this ETF could nosedive. And the US healthcare has a pretty big target on its back. Even as recently as a couple of years ago, we saw that the Inflation Reduction Act allowed the government to negotiate the prices of certain drugs for Medicare. That means the healthcare industry lost money because the US government decided to change the rules.
And in this case, VHT's 10-year annual average return has outperformed the S&P 500.
Bragging about 10-year returns is like bragging about past lottery numbers. Last week's lottery numbers don't help you win today.
Coming in at number 2 is Schwab's Dividend ETF. Dividend ETFs are notorious for being low cost and low volatility.
If you are worried about a recession and you want a less volatile portfolio, you typically should not be looking at different sectors of stock, because you're adding in new risk that you might not be aware of. For example, if you go for dividends, you're relying on certain sectors that are more dividend focused, like financials and utilities, and you're leaning away from things like technology. If during 2008 you did this and didn't change it, you got destroyed as banking suffered, while information technology thrived during that next decade.
Not to mention, they pay you out quarterly just for owning their stock.
I will continue to remind you guys that dividends are overrated. Just set up a quarterly withdrawal or monthly withdrawal from your fund, and now you have reliable income at a fixed amount that you know is coming out every single month. You don't have to gamble on whether a company is feeling particularly generous that quarter when they pay out their dividends. You just know how much money you're getting at a fixed amount. That is way better.
Our number 1 ETF operates identically to the S&P 500 during bullish markets, but goes risk off by investing into safer equities like gold when moving averages are broken.
Gold isn't really a safer investment. This is more myth than fact. Gold prices are very, very volatile, just like stock, and the return you get from gold is more similar to bonds than stock. So you have a very volatile asset that doesn't grow a lot.
So when the markets are getting crushed, our number 1 ETF only suffers a little bit while the rest of the market suffers a lot. Our number 1 ETF goes to Fairlead's Tactical Sector. Follow for more.
Let's take a look at the Fairlead Tactical Sector ETF. A net expense ratio of 0.7%. That's 70 basis points. I personally am only willing to pay 19 or less basis points for an ETF. A basis point is 0.01%. This ETF is expensive. And it's not a surprise it's expensive because it's actively managed. If I want to buy this ETF, not only do I have to keep an eye on who is managing the ETF, because if a key manager leaves, it could be a disaster in terms of performance. Additionally, I'm spending a ton of money on paying them to manage this ETF. It is worse than I ever could have expected. This fund's active strategy is just buying low-cost ETFs and charging a high price for it. This ETF is focused more on padding the pockets of the fund managers than it is on getting you as much money as possible. And you want to be investing in funds that work for you, not against you. Oh God, what an awful, awful recommendation.
There are 4 types of ETFs that I would recommend. The first one would be VTI, which is the total market ETF, and that one would pretty much encompass the entire US stock market. The next one would be QQQ, and that one is a little bit less conservative and a little more aggressive, but it's good for young investors because it's kind of focused around the tech sector, and tech sector is booming right now, so you can expect higher volatility and more gains, but possibly short term you could lose more money.
There is no reason young people should be investing in tech more than other sectors. This person is looking at the past performance and saying, wow, tech did really well. I bet it definitely will do well in the future, which is good for investors who have a long future like young people.
The next one is ARK, ARKK, managed by Cathie Wood. And this one is also looking towards that kind of these tech sectors such as Tesla, Square, and Shopify.
ARK is one of the best examples for why you should not be doing what this guy is talking about. This is the ARK Innovation ETF, managed by Cathie Wood, who was this all-star active manager in the world of finance. She loves new innovation and technology, and her ETFs were skyrocketing to the moon. And even though it has this high expense ratio of 75 basis points, Cathie Wood was printing money. But now, these days, people don't really talk about ARK, and there's a good reason why they don't talk about ARK. Everybody loves talking about ETFs that are doing well. Everybody loves being on the hype train, and they usually get to the hype late. And for a lot of people who talked about ARK, they got to it late. So this TikTok was uploaded in 2021, midway through the year. ARK ETF, at that time when he was telling people to buy it, was near the highest it has ever been, at about $120 a share. These days, you can buy ARK for $37. You would have lost nearly 75% of the money you invested into it if you saw this TikTok and you said, wow, I should buy ARK. This is why you don't chase the hype trains.
This is the quickest and easiest way to double your money without doing anything by simply just buying this stock. The ARK Innovation ETF simply finds every single stock that is about to bust, like if you did your own research, but they do it all for you. So if you simply leave your money in this ETF, which means a combination of stocks, then you'll simply just have free money.
ARK ETF at this time is trading at nearly $150 a share. This came out in early 2021. ARK, at the time this guy posted the ETF, was just about at its all-time high.
You see the past month's trend, 42.3%, 50% by just leaving your money in there. They also have a website, arkinnovationetf.com, where they show you everything they buy. Buy this stock and thank me in a month because you're about to make some free money.
Not only is this person chasing past performance, but they're also thinking about investing on a month-by-month basis. As investors, we're typically operating on the scale of decades. It takes the S&P 500 on average a year to go up 10%. Some years it goes up 20, some years it goes down 30, but on average the S&P 500 yields about 10% every single year. So if somebody's promising you 40% returns on a monthly basis, that is way outside of reality. I don't think this person has bad intention. I just don't think they're as smart as they think they are. Like, subscribe, you know the drill.